The distinction between market manipulation and strategic hedging represents one of the most intricate and consequential debates in modern finance, fundamentally shaping the integrity of global capital markets. At its core, this question revolves around intent, legality, and the economic purpose behind specific trading activities. While strategic hedging serves as a vital mechanism for risk management, allowing corporations and investors to protect themselves against adverse price movements, market manipulation involves deceptive practices designed to artificially influence prices for illegitimate gain. The complexity arises because the tools used for both purposes, derivatives, futures contracts, and large block trades, are often identical, creating a scenario where context and documentation become the primary differentiators between legitimate business strategy and unlawful conduct. In recent years, advancements in technology, the rise of algorithmic trading, and the fragmentation of markets have further blurred these lines, challenging regulators and participants alike to discern when a protective hedge crosses the threshold into predatory manipulation. To understand why this distinction matters, one must first examine the fundamental role of hedging within the financial ecosystem. Hedging is essentially financial insurance, employed by entities seeking to mitigate exposure to volatility without sacrificing their core business objectives. For instance, an airline company might purchase fuel futures contracts to lock in jet fuel prices for the coming year, thereby stabilizing costs, regardless of whether crude oil prices spike or collapse. Similarly, a multinational corporation expecting revenue in foreign currencies may use currency forwards to protect against exchange rate fluctuations. These activities do not create artificial market conditions. Rather, they transfer risk from those who wish to avoid it to speculators who are willing to assume it. This process enhances market efficiency, provides liquidity, and facilitates accurate price discovery. Without the ability to hedge, businesses would face unmanageable uncertainties, potentially stifling investment, innovation, and long-term planning. Therefore, regulatory frameworks globally are generally designed to accommodate and even encourage bona fide hedging activities, recognizing them as essential components of a stable economy. Conversely, market manipulation is inherently destructive, serving no productive economic function other than transferring wealth from deceived participants to the manipulator through fraud or deception. Manipulative schemes typically involve intentional conduct aimed at creating a false or misleading appearance of active trading or influencing the price of a security away from levels determined by genuine supply and demand. Common forms include pump and dump schemes where promoters inflate asset prices through false statements before selling their holdings, or spoofing, where traders place large orders with no intention of executing them to trick algorithms into believing demand exists. Another classic example is wash trading, where a trader simultaneously buys and sells an asset to generate fake volume statistics, misleading other investors about the liquidity and interest in that asset. Unlike hedging, which aligns positions with actual underlying business risks, manipulation is driven solely by the desire to profit from market distortions, often at the expense of retail investors and institutional counterparts who rely on transparent pricing mechanisms. However, the reality is rarely black and white, leading to a significant gray area where legitimate strategies can appear manipulative, and manipulators often disguise their actions as hedges. One of the most critical factors in distinguishing the two is the proportionality of the position relative to the underlying exposure. For example, a mining company hedging production volumes roughly equivalent to their expected output is acting legitimately, whereas the same company holding derivatives positions 50 times their production capacity suggests speculation or potential cornering of the market. Intent also plays a pivotal role, yet it is notoriously difficult to prove in court. Regulators must analyze internal communications, trading logs, and timing patterns to determine if a trader was genuinely managing risk or attempting to influence settlement prices. In cases like the 2008 Volkswagen short squeeze, where a corporate takeover attempt inadvertently created a market corner, the distinction relied heavily on proving whether the primary intent was acquisition control or inflicting damage upon short sellers, illustrating how complex and context-dependent these determinations can be. Regulatory bodies worldwide employ a variety of surveillance technologies and legal tests to detect and penalize manipulation while protecting legitimate hedgers. Authorities such as the U.S. Securities and Exchange Commission, SEC, and the Commodity Futures Trading Commission, CFTC, utilize sophisticated algorithms to monitor trading patterns, flagging anomalies like rapid order cancellations, typical of spoofing or unusual concentrations, a position ownership that exceed historical norms. They also scrutinize cross-market activity, ensuring that actions in physical commodity markets do not unfairly impact related futures contracts. Despite these advanced tools, enforcement remains challenging due to the speed of electronic trading, the anonymity provided by digital assets, and the jurisdictional gaps between different countries. Recent scandals involving cryptocurrency exchanges have highlighted these weaknesses, where massive wash trading volumes were reported without adequate regulatory oversight, prompting calls for stricter global coordination and clearer definitions of what constitutes market abuse in decentralized environments. Historical case studies provide valuable insights into how this battle evolves over time. The Hunt brothers' attempt to corner the silver market in the early 1980s demonstrated the dangers of concentrated accumulation, leading to regulatory crackdowns that nearly destabilized the entire commodity system. More recently, the Enron scandal revealed how energy traders could manipulate electricity grids and financial derivatives simultaneously, disguising predatory behavior as hedging under deregulated market structures. These events underscore the necessity for robust disclosure requirements and independent audits. Conversely, incidents like the GameStop saga of 2021 challenged traditional views, as retail investors coordinating via social media drove up prices, forcing hedge funds into losses. While some argued this was collective manipulation, regulators largely viewed it as legitimate, albeit aggressive, market participation, highlighting the difficulty in policing coordinated behavior among thousands of independent actors who share ideas but do not execute trades jointly under a central command. As we move forward, the future landscape of this debate will be heavily influenced by emerging technologies and shifting market structures. The proliferation of decentralized finance, DeFi, and smart contracts introduces new vectors for manipulation that existing laws struggle to address, such as flash loan attacks where liquidity pools are exploited within seconds. Artificial intelligence is also playing a dual role, enabling more efficient hedging strategies while simultaneously offering tools for algorithms to identify and exploit market inefficiencies in ways that mimic manipulation. Furthermore, the increasing involvement of retail investors through commission-free trading apps has democratized access, but also introduced the potential for viral sentiment to drive prices away from fundamentals, raising questions about whether social media-driven trading campaigns should be regulated similarly to traditional insider trading or collusion. Regulators must adapt swiftly to these changes, balancing the need for innovation and accessibility with the imperative to maintain market trust and fairness. Ultimately, the integrity of financial markets depends on maintaining a clear, enforceable boundary between strategic hedging and market manipulation. When investors believe that prices reflect true economic value rather than engineered distortions, capital flows efficiently to productive uses, supporting economic growth and stability. However, if manipulation becomes pervasive, confidence erodes, liquidity dries up, and the cost of capital rises for everyone. Therefore, continuous vigilance, technological adaptation, and ethical governance are essential. Market participants must prioritize transparency in their reporting and risk management, ensuring their trading activities align with stated business purposes. Regulators, in turn, must invest in next-generation surveillance and foster international cooperation to close loopholes that bad actors seek to exploit. Only through a shared commitment to integrity can the financial system fulfill its promise of facilitating fair exchange and managing risk, without succumbing to the shadowy tactics of manipulation. In conclusion, determining whether a specific market activity is manipulation or hedging requires a nuanced understanding of intent, proportionality, and economic context. It is not merely about the size of the trade or the instrument used, but rather the relationship between the trade and the actual risk being managed. While hedging acts as a stabilizer for the global economy, allowing businesses to plan with confidence, manipulation acts as a destabilizer, exploiting information asymmetry and structural vulnerabilities for private gain. As markets become more complex and interconnected, the responsibility falls on all stakeholders, traders, institutions, regulators, and investors, to uphold standards that prioritize transparency and accountability. By rigorously applying detection methods and adapting to new technological realities, the financial industry can protect itself from predatory behavior while preserving the essential utility of hedging. The ultimate goal remains the preservation of trust, for without it, the machinery of modern finance ceases to function, leaving only uncertainty and volatility in its wake.